Hey there, this is Ed from Ohio, the IUL guy. Just wanted to show you something. 30-year-old male wants to start an IUL, and we'll just call him Mr. Love. And you can see here he's male, 30 years old, and we're just going to go ahead and just show you a quick example of how an IUL can work. He wants to invest $400 a month and see what he can do with an actual IUL and becoming his own bank and creating cash value so that he gets money and can use the money during his life and not just when he dies. So in order to do that, to use this to build wealth, one of the things you want to make sure you do is you always want to use minimum death benefit, max cash value. What that means is when you're doing an IUL, it's kind of like a seesaw. So with a seesaw, if this is the death benefit, if you have a high death benefit, on this side over here is the cash value. So you're not building up much cash wealth during your life because it's all focused on the death benefit. Or you can go minimum death benefit, and that increases the cash value throughout your life. So it's kind of like a seesaw. So we make sure we set it up minimum death benefit, max cash value, because he's wanting to create wealth. We're going to go ahead and set in here, we're going to specify the premiums at $400 a month. You can see monthly, 400. And then we're going to go down here and we're going to just set this up for 31 months because it automatically does that. 31 years until M is infinity. So we're going to set it up from the age of 30, because that's how old he is, to age 60. And then after that, it will start to pay him a lifetime income benefit. So let's just take a peek and see what the numbers look like in this exact scenario. So if at $400 a month, there's 12 months in a year, 400 times 12 is $4,800. So this is the yearly premium that you see he's going to be putting in. I like to say more like, instead of a premium, it's deposits, because he's depositing into his own wealth. It's going to immediately give him a death benefit over here of $373,000. He could actually get more death benefit with that kind of a premium, but we want this to go towards cash value. I'm just going to show you here. I like to go straight down to year 10 because that's about the break-even point, which means 10 years at $4,800 a year, you've put in $48,000. By then, you're about $48,000 in value, and at that point, it starts growing faster than you can put in. So the next year is $56,000, even though you only put another 48. You only put 48,000 in. But so now let's just go down here. If you go down to year 20. If you've put in $4,800 a year times 20 years, that'll be $96,000 you've put in. He's gotten about a 50% increase. It's worth about $150,000. This is the cash value that's growing over time. This money can be used for anything. You can use it. My preference is, if you're going to use your money, use it to buy things that are going to make money. Buy assets, buy a duplex, buy real estate, buy anything that a business that you can, that's going to actually pay back this money so it continues to grow faster. You can take this cash value out at any time as a loan. It's tax-free because that's what loans are. Therefore, let's say you go to buy a car. Well, if you buy a car, instead of buying it and using the bank for money, take the money out of here, borrow it from yourself, you pay yourself back with interest, you're actually filling this up further. Anyways, that's at 20 years. You've made about 50% on your money. At year 30, because that's how far we went, think about it, 4,800 times 30 is going to be about 100 and, let's see, 90, 130. Well, let's just do the math. I'll do it with you on a calculator just to make sure that you trust me. 4,800 times 30 years, 144,000 you will have put in, but in 30 years, but you will have a cash value of 340. So you've more than doubled your money. And look at this. That death benefit automatically grows with the process. The advantage of that is, let's say you have kids by then, or you have people that you love by then that you'd like to leave money to. But let's say you take 300,000 out and you buy some multifamily homes. Those multifamily homes are now, since you don't owe money on them, they're paying you. They'll pay back this for you if you want, or they'll provide you a monthly retirement income. So keep this number in mind. This is at $400 a month straight through the whole time. you'd have about a $340,000 cash value that you could take out, do whatever you want. And you have the death benefit over here. Another number to remember is if at that age, you'll be 59, you'll be turning 60, you'll be able to get a $21,980 a year income. So that will automatically come to you as loans out of your cash value. It will automatically come every year as a lifetime benefit income starting right at age 60, 21 grand a year on top of your Social Security or whatever other retirement funds you've built up. Now, the power of this is this money is available. You can borrow out of it, pay it back, borrow out of it, pay it back. And you don't ever have to do a credit check. You don't ever have to do anything because it's your money. And it's a loan, so it's tax-free. This money that comes to you annually is tax-free. And so I want to show you, that's the key to this. That's at $400 a month. Now, keep in mind that the longer money, that's the time value of money. The longer it sits there, the faster and longer it will compound. So I want to show you another scenario here. I'm going to go back to the death benefit. We're going to keep everything the same, but time value of money. I mean, think about it. If you let that money sit there another 10 years. So we did this right when he stopped putting money in. At year 31, he actually started taking money out. But let's say he went, I'm going to let that money sit there for 10 years. I'm not going to start taking money out until I'm older. And I'll let the numbers explain it for you. So look, same scenario, all the way down to year 30. He put the same 144 grand in. It's still worth 340, and he would get the 21 that we said. But let's say he just lets it sit there and lets it grow. Look what it's growing. You can see by the time he's 69, he will have grown that to $610,000 without putting any more money in. So he will have literally almost doubled his money by letting it sit there another 10 years, 9 years. That's the time value of money, letting it sit longer. So we go from 340 to 610, but look what that does. Instead of getting 21,800, let's say 22,000 a year, he's now getting 43,000 a year. More than double what he was getting just by letting this sit an extra 1, 2, 3, 4, 5, 6, 7, 8, 9 years. So you see the power of this. It's the time value of money. It's compounding on itself. So instead of 340, it goes to 6. Death benefit grew to 705. Okay, and this right here grew too. I want to show you one more thing showing the time value of money. Let's say someone got aggressive and they wanted to put more in at the beginning. So I'm going to actually change this. Let's say just for the first 5 years. So let's say this is year 6 through 30, he's putting in the 400. And let's say years 1 through 5. This one here, 1 through 5, he was putting in the same 400, but let's say he was finding another $3,500, like say from tax returns from the first 5 years, or just went a little bit more aggressive. So instead, an extra $3,600 a year would be another 300. So that's $700. Let's do this. Let's go specify. For those first 5 years, let's say he was putting in 700. Fix this over here. Still the same 400. So instead of putting in 4, he found an extra $300 a month, or let's say a tax return once a year or something like that. Let's look at this and see what it does as the time value of money. So that means the first 5 years he would have put in $8,400, right? And it's going to grow a lot faster, but look at, and then the same back to the 4,800 for the other 25 years. Same time. Now look at this. Instead of this number being 340 here, it's now 420, 424. And look at this. And at the same weight, remember we had, what was it, 600,000. Look at this. Now it's 750. See the massive, by just putting in an extra $3,600 for 5 years, an extra 15 grand over the life, but by front stacking it, it has time to compound all this time. So that means your cash value over here at age 59 is 4.25 instead of 340 like we did. Anyway, so let's real quick just go back to the original plan. just cut this out here, totally eliminate that one. We're going to put this back to the 1 through 30. So there you go. If he's done, so we'll go right back to that. And this is just putting it in at the 1 through 30. And at age 59, he will have put up 340 grand. And that's with a steady 400 bucks a month. And all that time he has access to this money. So Mr. Love, 30-year-old man, that's what you can do with 400 bucks a month. And like I said, if you let it sit there after you're done and you let it sit there for 8 or 9 years, you've actually grown your life. Now, here's one other quick thing on this. Let's say in this scenario, his cash value is at 610. He starts pulling out $43,000 a year, but he's only still put in that $144,000, right? 4,800 times 30 years, 144,000. Let's say he lives 10 years to age 79. Okay, 10 years means he will at 43,000 a year. He will have had usage of all this money all this time, but 43,000 times 10 is 430,000 he'll pull out of the 4,800. You see that? It's pretty cool. If he lives to be 85, that's 15 years. This will keep paying him that 43,000 a year till he's, I mean, what if he's 120? I mean, that's kind of crazy numbers, but let's say, so this starts the payout. Where did we say? With this one, if he does it up here, starts the payout up here, it was like 22 grand a year. But here it's 43 grand a year at age 69. So let's say he lives to be 85 years old. So what is that? 85 minus 69 and actually 68 because he starts collecting at age 69. 17 years if he collects times 43,000 a year, 43,664. He will collect $742,000 from something he only put $144,000 into. So, I mean, and he still has a death benefit that whenever he dies, that people will get. So that's just a quick scenario for Mr. Love, 30-year-old male who wants to put about 400 into an IUL. Just wanted to show you the different things he could do. And again, the big thing about being your own bank is that any time during this process, you could borrow out of this money. And let's say you borrowed 100,000 out of this 162. This will still, let's say it's earning, even if it was only earning 5%, it would take out of the 162,000 times 0.05, it will grow on its own $8,100 that year, all by itself. But even whether you borrow the money out of it or not. So if you borrowed 100 grand out of it, it's still going to grow $8,100 based on this, because that's a loan using this as collateral. Just like if you were to buy a house, let's say you had a house that's free and clear. If you got a loan on it, if the house goes up in value, it goes up in value based on its value already. It's the same thing here. Whatever the loan is on the property does not affect how much it goes up in value. So this maintains its value even if you borrow that money to buy more assets that you can feed right back into here to keep it growing. It just becomes crazy numbers when you can become your own bank. And like I said, the time value of money means it's the best to start as early as you can and the fastest you can. I've got a 20-year-old in the same scenario that instead, if she did a 400 a month, she's doing 300 and she's going to have 750,000 by the time she's around in her early, like 60 years old. So it just depends. But that's the time value. So the quicker, the sooner you get started with an IUL, the better. Every day you waste is interest you waste, money you waste towards your future, and time value money. And then just start plugging away. Anyways, this is Ed from Ohio, your IUL guy. And if you have any questions about IULs, you want to see your own scenario on here, let me know. And hopefully this wasn't too long. Try to keep it around 10 minutes, but I think I went about 14. So have a great day. This is Ed from Ohio, signing off.